Good morning, traders, and welcome to the Bookmap Pro Trader webinar. This is actually eclipsing the series. We're going to have the series next week. It's actually kind of funny. It's going to be 2 weeks of series, basically. We have one tomorrow as well, and we may have a pro webinar on Friday. Today, we have Markets and Mayhem of Traderade. We've done another webinar with him before. It was excellent, very concise and pertinent data here. Trader biography. Markets and Mayhem is an experienced trader and investor cutting his teeth in the market starting in 2005, learning to trade and then invest after doing some of the first trades during the dot-com boom, which sparked a passion. Mayhem has experience analyzing flows, geopolitics, macro, systematic trading, and technicals. And I have Mayhem's contact information here. They have a website, traderade.com. There's another macrovisor.com, and then a YouTube channel, and then also some special offers here. I believe this is correct. If it's not, then I will update it, and I'll put this into the chat for you. I updated it yesterday, but it doesn't look correct now. Anyway, let's go through disclosures and turn it over to Mayhem. General disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. All right, so let's get into it here, and I will project Mayhem's screen. Okay. All right, Mayhem, we're all set. Take it away.
All right, folks. Well, hope everyone's having a good start to their trading week. Certainly an interesting day so far as we've opened, and we got rejected pretty well off the open here. And, looking pretty interesting as we retest some of these pre-market levels. But before we get too much deeper into the intraday trading, let's talk a little bit more about how I trade and a focus on Bookmap with this. The theme of this presentation is Coalescence as a compass. The idea is when we look at trading, what we're really trying to do is come up with a system that is repeatable, that we understand, that we have confidence in, so that way we're able to see our trades through, but we're also able to get out if we no longer have a signal that has us in a trade or if we're exceeding our maximum risk. So for me, coalescence is key because looking for multiple convergences helps me increase my confidence. So if I can see that there is a lot of positioning at a key strike in SPX, we've got a large level of resting liquidity at or near that level. We've got the longer term auction perhaps showing us a lot of people like to transact at that level. That's telling me we're probably going to go back there, and that helps me to increase my confidence in putting on a trade if I'm expressing that opinion. That also helps me to have a higher probability of a successful outcome because I'm being more disciplined in my approach. I'm not taking on trades for the sake of taking on trades. And I just want to put that out there because I think it's an important part of our growing process as traders, no matter where you are, but especially earlier in the process, to not take trades that don't comport to a system that we understand, because then navigating the trade becomes more difficult. Our consistency goes down, right? And as a result, we may find ourselves revenge trading or not being as confident or otherwise sort of self-sabotaging. So I rather go by a system to quantify how I'm going to get into my day trades and my swing trades. And the theme of today is going to be coalescence as the driver for that system. Doing so, having such a systematic approach also, it decreases the likelihood of taking on those low confidence trades. Because if you say I'm only trading my system, you're not taking the stuff that kind of comes on the periphery of your radar and you're like, no, I've got something better to do with my time. I want to make sure that I'm putting my money and time into good use. It also reserves emotion and impulse. When you see yourself lurching into doing something because you feel it rather than it makes sense, sometimes those can be good trades, but often they're not. And the biggest part is Is it something you understand? Is it repeatable? Is it something you can put your risk reward on right off the gate? And if you can't, those gut trades can really start to hurt after a while. Less trading is also better for overall capital preservation. Now, I know some folks like to scalp aggressively, and if you're good at it, great. But at the end of the day, it does exhaust our time to be sitting in front of the screen the whole day. It exhausts our intellectual capital, and it can also put us into situations where we might have more churn from commissions, slippage, and any losers. So I like to have a system that helps me get into trades that are high risk, a good favorable risk reward ratio. So something where I'm feeling like maybe 4 to 5 times reward to risk is a good benchmark. I see the market's getting sold down a little bit here. We've taken out the lows. We will get to this, but it does look like we're starting to have what you could quantify as a downwardly trending intraday kind of price action situation here. Mapping out key levels. This is really important to me because I need to know this going in advance of the trading day. I don't like to get into the day and kind of fumble around and figure out where I am. I'd rather do some prep overnight and coming in before the market opens. And some of the tools that I use help me to do that automatically. But however you do it, having those levels available before you're in a trade helps to understand what your risk and reward is. It also helps to understand where some of those price targets and key resistance and support levels may be. So for me, I like to look at options positioning across the full S&P 500 index chain. I also like to look at the 0DTE most active calls and puts in SPX because that is a really important driver of price discovery. I like to look at prior key auction levels in multiple volume profiles, right? So I like to look at it both on a longer term time frame and also in an intraday time frame. Weekly, daily, and intraday are my key volume profiles that I look at. I also like to look at Bookmap for large levels of resting liquidity. Like we can see if you're watching Bookmap right now, 4450 ES is a pretty key level with 489 contracts resting on the bid. And then I'm pretty key into looking at the institutions versus retail component or icebergs versus stops. And you can see there's a bit of a theme there today with icebergs on the rise as stops are getting blown out a bit. So we'll talk a little bit more about that. First, let's talk about options though. So full chain options positioning across SPX, there's usually about 10,000 contracts on the chain that you have to be aware of across all the expirations and all the strikes. Most of the price action, most of the trading happens within about 5% of spot. So you don't necessarily need to be going all over the map to really look at where important options trading is. It's usually within, up or down 5% of spot in SPX. And so I've created a number of charts that just run automatically to help me map this out. There's a variety of services that do similar, but the goal is to just be aware of these levels and quantifying them on the full chain through gamma exposure I found to be quite helpful. And that's just your idea of what dealer exposure is at those levels. So the largest gamma exposure or GEX above the spot price is what I call a wall of calls. It's sort of common phrasing for people that are trading options to look at it as such. It often acts as a level of resistance. Similarly, below that, the largest net GEX below spot that's negative is that wall of puts, right? So those are two areas to watch. They typically fall on pretty big even numbers. Sometimes you get the 50s in there, but 4,400 and 4,600, these are two levels to watch in SPX options positioning. You can see right now the implication is about $12 billion of selling per SPX move of 1% down, and vice versa, about $12 billion of buying for every SPX move 1% up. And we'll talk a little bit more about what that means, but the implication is that dealers are short gamma here or in negative gamma territory. The next area that I like to look at is gross gamma exposure. The largest area of that tends to be a bit of a vol trigger. What does that mean? It means when you cross below that level, which we are, of course, quite a bit below now, you have an increase in volatility. So not only do you have that, as we are at present, negative gamma environment or dealers short gamma, you also have us well below this vol trigger. So that's important. It just adds to the potential for more erratic intraday and intermediate term price discovery trends. We're also at a time of year where seasonality matters because volatility comes back and volatility starts to become more pronounced from mid-August on. And we've certainly seen that so far. We also have other factors. There's less volume and less liquidity in the market over the later summer. And that also tends to add to volatility because it takes less volume or less order flow to move price more if there's less participation. So all of that you just got to kind of keep in the back of your head. That moves might be a little wider. So that also means position sizes should probably be a little smaller and stops should be a little bit more judicious about managing that risk. So walls and triggers, these are what we've just looked at, right? A call wall or a put wall tends to act as a level of resistance or support respectively. A volatility trigger, particularly a very large one like we had on the last chart at 4,500, can act both as a magnet for price as well as a level that once we push below, price discovery becomes more chaotic. And we've seen that since we pushed below this 4,500 level. And even last night, we challenged it in the overnight. If you adjust ES for SPX, it's about a 16-point delta. And we did test it several times overnight. We got rejected ultimately. So it is a pretty key level. It's become a bit of a ceiling here with the way that trading is happening. And 4,400, based on options positioning, could be a pretty important level of support for buyers to try to defend. Now, these levels, they can and will move regularly, particularly during large market moves. OPEX week, which we're in fact, tomorrow is Vixpiration and the release of Fed minutes, so that'll be fun. And also where there are event catalysts that might change hedging flows or otherwise. Gamma flip changes hedging dynamics as well. This is another area that's important to take into consideration. So the naive model that we have at Traderade calculates the gamma flip based on assuming all of the options exposure on the SPX chain is bought to open, because that data, whether it's bought to open or sold to open in terms of what's creating open interest, isn't readily available. But most of the options positioning by and large is bought to open. So it's a relatively accurate portrayal. We have other large banks like Goldman saying also they see dealers as having basically a short gamma or negative gamma environment as well. So the model works. And what it's showing us now is that gamma flip level is approximately 45.24. That's quite a bit above us, about 75 points above us right now. Again, adjusting SPX for ES levels with that delta of 16 points. And that delta continues to flatten out as we approach the contract roll in September. But this is telling us that there is a fair amount of a chase dynamic at play. That idea that when we're in negative gamma territory, dealers are more likely to short dips and buy rips. Sell rips and buy dips is the opposite dynamic that you see, which is long or positive gamma. So in a short gamma environment, to recap, you have dealers that are more likely to buy rips and sell dips. That exacerbates volatility. In a long gamma environment, you have dealers more likely to buy dips and sell rips, which compresses volatility. So this is the environment we're in right now, a short or negative gamma environment. And that is something to keep in mind when you're looking again at positioning and how you're going to size going into a trading day or week or month like this. Now, I like to look at the 0DTE most active puts and calls for SPX. This was taken from yesterday's data. This is just a quick chart that I look at regularly. I've also put in a plugin to the Cloud Notes on Bookmap that visualizes this on screen. We'll show that shortly. But the reason this data is important to me is that SPX is the biggest options market in the world. And 0DTE trading in SPX is more than half of all trading. More than half of all options in SPX are bought to close within 6.5 hours or less. So that's a bit of a mind-blowing stat. And then, options activity is getting more and more, I would say, a key component of the market, not only because of how much of a driver it is, but also how large it is overall. So 0DTE SPX options trading accounts now for 53% of all options trading in the index. Let that settle in for a second because it's a bit of a mind-blowing stat. Volumes are regularly hitting all-time highs in these options, and about 600 billion of notional value in SPX to expire within 6.5 hours or less trades every single day. And it gets better because volume continues to hit all-time highs. So for us as traders, it means we have to adapt and evolve to survive and thrive, right? If options are driving the market, that changes some of the dynamics as to what we should be watching. It's actually gotten to the point now where the majority of ES trading is driven by SPX market makers because there's so much flow happening in SPX 0DTE options that ES is merely a reflection of their hedging activity for most of the volume. Obviously, not all of it, but most of it. And that changes the game a little bit. It means we need to be more cognizant as to what people are doing, particularly with those short-dated expirations. Now, volume profile and resting liquidity are other areas that I find it very important to watch. I like to watch the volume profile, as I mentioned, intraday, on a daily time frame and a weekly time frame, mapping out those key areas where market participants have wanted or not wanted to participate. To understand how they may react to those levels is important. Like in a high volume node, it acts more like a magnet, and a low volume node acts more like a decision zone where market participants haven't wanted to stay there in the past and often don't in the present. So you tend to see either a rejection or a break above. Whereas with a high volume node, you may get kind of sucked into that and churn around for a bit because that's an area where the auction participants have really enjoyed transacting. So it's important to watch those levels. That helps to give me a better idea of what people have thought in the past. And then to know what people are thinking in the present, I do like to look at resting liquidity. Bookmap is a brilliant tool to do that. And I really like to look at contracts of 200 or resting offers and bids of over 250 contracts in size. And that's during regular trading hours. Obviously, after hours, it's a bit different. But that helps me to map out where I'm going to pay attention to on the chart versus where I'm not going to quite give as much attention. I find those larger areas of resting liquidity tend to be more magnetic, particularly on a day where you're trending and you're going in the direction towards one of them. And I like to look at institutions versus retail. And that, for me, looks at stops and icebergs, right? So icebergs are more likely to be institutional participation, and stops are more likely to be smaller traders. They may not be all retail, but they're likely to be smaller traders. And that helps us to determine the flows behind price action, right? So if we see a lot of iceberg buying while the market is starting to dip, that can be a sign that you've got a larger institutional player that's starting to step in. What catches my attention is size. So I've seen days turn around almost on a dime when you get someone going in with thousands of contracts, particularly, 3,000 and above. That can put a little bit of a change to overall price action and increase the amount of potential that, you're going to have a reversal at that point. Because first of all, if you're a seller in that situation and someone huge comes in and just lobs 3,000 contracts in, you're going to see that. You're going to say, okay, well, someone has a completely different point of view than me and they probably have a lot more money. Maybe I'll step out of the way. And you often do see that. You often do see that sort of turnabout in market dynamics. But you can't just see the iceberg and get in. You've got to see the price action confirm it as well. So the other side of it is it's helpful to see stops being blown out, right? Those sell stops being blown out as the icebergs are buying. So smaller players are getting taken out of their positions, larger players are accumulating, and you're potentially going to see in the price action then that validation that could give one idea of getting into the trade. And that's just an example. Using this as an indicator, I found it to be very helpful. So let's talk a little bit more before we dive in, just about the basics here, because I think this is a really important part of trading. It's psychology, and the psychology of trading determines whether we survive or we don't, right? So right now, we have a lot of people, unfortunately, that have kind of gone into just reflexively buying every dip, and I get that. It's worked. It works until it doesn't. And one concern with that is it doesn't come with basic risk management practices. It doesn't always necessarily come with a system, a repeatable trading strategy that allows us to understand what we're doing, why it works. And I think that's a really important component of successful trading. Because trading is, if you do it seriously, if you're going to do it full time, it is a job. It's not just lottos and Lambos and betting on calls and, getting 100-fold returns or whatever and just being rich and retired and moving to a private island within a week or two. I know that some folks advertise it like that. I know folks out there listening to this either live or later are going to laugh a little bit. But the reality is that trading is really more like a job. It's a career. If you're going to do it well, you have to be able to do it consistently. If you're going to do it consistently, you have to understand what it is that you're doing. So that's an important part of trading, is the consistency component, right? And how do you become consistent? You have a system. A system keeps you honest. If things don't comport to that system, you don't get in the trade. If the system tells you the trade's not working, you get out. If the system says that it's time to take profits, you take profits. And when you build a system that works for you, it doesn't mean it's set in stone. You got to keep iterating and improving. There might be dynamics in the markets that shift. And I think it's really important to also be open-minded about how we have to evolve. Like looking just in this presentation about how much options are now a key determinant of price action. Well, then we have to evolve our system to take that into consideration, right? It would behoove us to do that. So that means we take trades that fit the system we've created. We avoid those that do not. We journal our trading. And I meet a lot of great traders that do not journal. I still think everyone should journal. I journal. I meet a lot of other traders that are very serious about this, that look at it as a job, as a career, and they do journal. Because no matter how good you've become, you can always get better. And one way you do that is being your own sort of reviewer, right? You've got to be your own critic. You've got to look through all your trades and say, what's working, what's not working? How can I focus more on the approaches that are working? How was I feeling when I got into these trades that did work or didn't? Because emotion does play a big role. We are humans after all. Most of us are not using automated code to execute all of our trades. And even if we are, we have to trust our system, right, to stay in those trades. So it's also about making sure we have a quantifiable system. And in order to come up with one that we can continue to iterate and improve, journaling is a key component. So I like to have a journal that talks about, how I entered the trade. Ideally, I entered the trade with more than one entry. I don't like pretending I'm smarter than the market. So often is the case, unless it's a very short time horizon or it's a small position, I will use multiple entries and ideally exits if I'm afforded the opportunity. And I journal that, not just the first entry, but every one. What was my thesis? Why am I in this trade? So that I can look back at that if it's a longer term trade and understand what I'm doing, what quantifies, because at the time when we're doing the trade, it all seems very clear, but then time passes and some of those things may not be recalled quite as easily. So we have to have that written down. And we should have a system that's formulaic, so it's very easy to replicate, right? It's almost like template driven. And then finally, when you get into this routine, when you have a system, when you are consistent, when you find yourself disciplined, you're going to save a lot of mental energy. What's the biggest thing that gets traders? Burnout. Why? Because we're spending mental energy doing nothing. Like staring at every tick on the screen is not going to be what gets you to retire early. Okay, you have to be smart about how you use your time and your energy and consistently become smarter and smarter about that. I know some really good traders who only trade like the first 2 hours of the day and then they're just done. And it makes sense if you look at the way volume is. There's not much to do sometimes until like the last hour, hour and a half. So be sure you preserve your mental capital. Trading is not a sprint. It is a marathon. You have to be there next day, next week, next month, next year. You have to be there with your capital. You have to be there with your mind. You have to be there as a better version of yourself than you were previously so that you can look back and say, wow, look at all these milestones. Well, how are you going to quantify them without a journal, right? And then you can look back and really see how you've gotten better over time. So that's the main takeaway is, not only are we looking at coalescence as a compass, that's the key theme, but I want to dive into psychology because no trading strategy will be successful without a really disciplined, objective approach. And then finally, disclaimer, what might work for me might not work for you. My system is not the end-all be-all. It's just what I've come up with trading the markets since 2005 and learning and kind of applying different knowledge from my experience and those of others that I've admired and looked up to into my trading style. So take what works for you. I welcome your questions and your feedback as well once we wrap up the presentation, but make sure that you don't try to just apply it literally as a drop-in. You've got to make sure whatever you're trading works for you, your personality, your system, whatever allows you to be consistent and disciplined. So let's dive in. We're going to look at some real-time examples, including my dynamic SPX options mapping system as visualized through Bookmap. I'll discuss how I use Bookmap as a part of my day and swing trading strategies for ES in the broader market. And of course, as I mentioned, I will welcome your questions and feedback as I conclude. So I'm going to switch screens, folks. Give me a second. And we're going to go into Bookmap here. And Bruce, I don't know if you need to grab this again, but
yeah, I need to get that again.
here we go. Here's the Bookmap stream.
There you go.
All right, folks. So I'm just going to resize things because I use this on a smaller monitor. So you can see on screen that we've got a number of familiar parts of this chart and one area that looks a little new. So I'm going to walk you through just the new part first so everyone understands what we're talking about, what we're looking at, and then we'll get into what we're seeing in Bookmap. On the farthest right column, you'll see something called options. And in options, you'll see various labels. And as we zoom out a little bit, you can see that there's more and more of those labels for key levels. Now, what we're doing here is mapping out some of those areas that you saw on the charts, right? Those SPX charts.
Excuse me, Mayhem.
Yeah.
The resolution's pretty high. I don't know if you could make it a bit lower.
Sure. Yeah. Let me switch screens again real quick and just put it over here.
Yeah, that'll.
Let me know. Is this better?
Great. Yeah.
Okay. All right. The perils of ultra wide screens. Okay. So we've got a number of key options levels that you can see on this right column here. Hot call is the most active SPX call. Flip is the gamma flip level. Vol is the vol trigger. Key is one of these key areas of options exposure where there's an unusually large amount of exposure. And then hot put, about where we are right now, not much of a coincidence, is the highest activity put for that 0DTE SPX options chain. So why is this all important? Because it takes all of these levels, both full chain and 0DTE, and converts them to Bookmap. So I can see them right on screen. So it just saves me a little bit of a time. This is something that I've put together recently. It'll eventually be available on the Bookmap marketplace. But the reason that I wanted to show you all this today is because with the outsized role that options play in the market, being able to have this just kind of bright built into the screen, it's been a game changer for myself and many others. And it's a little bit easier to visualize it rather than having to go through, a website, look at a link, or have a different chart in another window. So I like to be simple. I don't just like Coalescence as a compass. I like to reduce complexity. There's nothing wrong with simplicity. And Bookmap is one of the screens that I look at the most, particularly now that I have so much on it. So as we look at the Bookmap window today, one thing that calls out to me is there's been a very patient bidder here, sitting just above 4,400 for a long time with this 1,000+ order. They've been there for, I want to say, almost 2 weeks now, maybe longer. But that's something I have my eye on, because typically if someone sits there with size for a long time, it's not going to be a spoof. It's someone who's genuinely interested in bidding the market down, which would be a pretty key level too. Like SPX 4,400, as we looked at on the options positioning charts, is a key area. It's a wall of puts, and that would be just around here, around 44.16. So this is a little lower, but when you get those big tests of key levels, you can see it visualized here, that tends to get a little bit of an outsized move. So you could have a test at that level, maybe a little bit of a break. This order gets pulled in. So that's something I am looking for. I am looking for this market to probably retest that SPX 4,400 level over the next couple of weeks. I don't know if it will be this week, but I do think it's very interesting that this is a week where we're going into options expiration. We've got a number of catalysts. We've got the Fed minutes tomorrow with expiration, which can further amplify the potential for volatility. And we'll see what the Fed minutes do, but this isn't a particularly well-hedged market into this dynamic. One other area that I didn't talk about during the presentation, but I think is important to understand, is skew and how that impacts a week like this where we're going into options expiration, right? So the flows that are talked about often, Jem Carson talks about them as the second order Greeks, the Vanna and Charm flow, or basically delta decay and theta decay flows. Those intensify a lot over, really this week up until Wednesday. And that's sort of like Wednesday is going to be sort of peak flow. And then we're off. All those flows are kind of turned off for the next 2.5 weeks. Why is that important? Well, going into this week, skew on the S&P, which is the premium between calls and puts, it's lighter than it was. So some of those hedges were taken off, which means those flows won't be quite as strong. As we can see today, they weren't enough to sort of save the market from itself this morning. Typically, the strongest time for those flows, the first and last hour of trading. And the other side of it is that on the single stock side, particularly the mega caps, we're very call skew heavy, which means that these same flows actually go the other way. They take liquidity out of those stocks as you approach OPEX. So just some dynamics to think about as we're heading into what seems to be a trend day lower. And that's really what I'm looking for as we've broken below the trading range in the first half hour of trading and multiple other time frames as well. We can see it's become a bit of a risk-off day. There are some reasons for it. I know that folks want to believe that a rate cut from the People's Bank of China is bullish, that it adds liquidity, but I think it's actually the opposite. I think it's us seeing that they're not doing nearly enough and they continue to limp along to try to catch up. On the other side, we got really hot retail sales and consumers were gobbling up discretionary items again, which is probably a sign that the battle against inflation may have a little bit more work to do, similar with what we got with PPI data last week. We do see bonds continuing to move lower. Yields are the highest they've been since October. And that does matter to the market. And that is, I believe, having an impact on price discovery today as well. We do see some more stops getting blown out here, about 428 contracts sell stopped out. So we're seeing a continuation of this downside. To me, I'm looking at 44.50 as a pretty easy target. It's got a rather ominous number of contracts on that bid, 666. So, that's okay. They moved it up just because they heard us talking. So now it's 668. But now it's 739. So someone's getting a little bit more serious, stepping up that bid, 740 now. And they're probably seeing the same thing that we're seeing here, that there's a further breakdown in price action, that this thing looks like it does want to continue to move a bit lower here. And, there are reasons. We've had a really great rally this year, but it's been very narrow. And while there's been some broadening out, I wouldn't say that we're at a point where we could call it healthy. Meanwhile, the leadership in that rally has been a lot of very expensive stocks. So seeing a re-rating of that risk is not too unlikely, particularly as rates move higher and higher. And we're now at a point where equity risk premium is at the lowest level in about 22 years. So that means basically you're getting paid better to be a investor in treasury paper and notes than you are in stocks based on earnings yields versus sort of risk-free returns. But moving into just the daily time frame here, I see a number of things that do continue to concern me about the way that the market has been trading. You've got the NASDAQ and the Russell also quite weak today. The Russell selling off the way that it is, even though it is an index full of garbage companies and 40% of them don't make any money, it is a risk indicator. It's a risk appetite indicator, similar with specialty funds like ARK. And when they're leading the way lower, that is a bit of a risk off signal. Similarly, when they're leading the way higher, that's a bit of a risk on signal. So we do see some risk off signals. We also see it in just overall market breadth. It's about 75% decliners underneath the surface and 77% of stocks making new lows versus new highs intraday. So it is overall a bit of a challenge day, but it makes sense with, the sort of phase that we're in now. We're starting to give back some of these returns. We are not only in a seasonally elevated time of year for volatility, we're also in a seasonally poor time of year for price discovery in stocks. August tends to be not the greatest month, and September follows on with a little bit more pressure. And another factor that adds to that we do want to consider just as a part of the liquidity dynamics here is the Treasury is now issuing more long-dated debt. Not this week, but last week they did. And they're going to continue doing so as they upsize their issuance. And that longer dated debt isn't likely to be pulled out of the reverse repo. It's likely to be pulled out of bank reserves, and it is likely to have an effect on liquidity in the market. And that's been one of the drivers of this rally. So just factors to keep in the background for us in August, in September, as we move throughout this third quarter, that there are a number of drivers that could upsize volatility and fatten left tail outcomes as we're trading this market. The hot put level still hasn't moved, so that tells us that, even though we have a market that is trading weak, the overall options activity has not moved lower, so they're not targeting a lower strike yet. That data is updated every 2 minutes, so we'll see when it refreshes if we get any different information on that. But for now, this is a market that looks like it wants to continue to move lower. I don't know if our friend down there just above 4,400 gets his fill today per se, but I think that Mr. 800 contracts at 4,450, that's probably a no-brainer that we're going to see that get filled.
Mayhem, I have a question for you.
Sure.
So based off of that multiple confluences there that you just ran through, what do you see in Bookmap in the order flow that might also point to this move lower?
Yeah, so that huge resting bid at 4,450 has me very interested. I think that someone's quite serious with their 800 contracts, wanting to bid in at around that level. Maybe it's someone who got a nice short in at a higher price earlier. So that's one thing I'm looking at. The other thing I'm looking at is that distribution from the icebergs. Institutions continue to sell into this. They're not yet absorbing this, and so icebergs remain pretty negative, negative 764. Stops are also getting blown out a bit, but that's not yet at an extreme where I would say we've seen the end of the stop run. Like we haven't seen that kind of chasing price down in a stop run. They've been pretty orderly. So I'd say so far, it looks like the market positioning dynamics are still vulnerable to further downside, and that institutions are positioned for that. And we're looking at that resting bid to kind of confirm that, right? We've got the institutions that have been iceberging into this move lower, and then we've got that large resting bid looking to either cover a short or get long, or some combination of two down there at 4,450. So it all kind of adds in to that same picture.
Excellent. So then, so that's a interesting way that you're using the icebergs there of just kind of overall bigger picture general feel that you want that to go along with the trend in this case, meaning that the larger players, they're not covering yet, and they're certainly not interested in buying at this point.
Agreed.
Okay.
Yeah, and that's something that I really do want to see to feel more confident about. If I was going to be saying that this move is over to the downside, then I would want to see institutions lapping up some of this weakness. And I'm really not seeing that. Instead, I'm seeing them increase their bid well below current price, about 10 handles below, which tells me they're really looking for the opposite. They're looking for lower prices before they start piling in.
Yeah. And then I'm not looking for spilling any of the secret sauce here, but how would you kind of edge into a trade here? Or like what kind of areas, or you don't have to go through anything specific right now in the live market, but in general, like what is it that finally makes you pull the trigger?
So, in a situation like this, if I was looking to go the other way, one thing that I'd like to see is some changes in the liquidity dynamics. So I'd like to see institutions become larger buyers. I'd like to see that sort of stop out moment where you see a lot of retail really get blown out with some some singles to the downside where there's people that are just basically getting out at any price they can. That would help me to say, okay, that happens first. Maybe we've got a little bit of a blowout. Then we see the iceberging continuing to buy. That would help me get a little bit more confident on the reversal. And then possibly we start to see some of this key options activity move back towards this level here. So maybe we see the hot put move a little bit lower, the hot call move a little bit lower, telling us that the options traders are looking to have a different price range, but perhaps one that allows price to move a little bit higher on this reversal. Because right now, even with the current hot put, hot call, they're still kind of looking for price to go a bit higher than where it is right now. So for me, I do like to look at a little bit of like the other thing that I would like to see, Bruce, that we often see when we're seeing a credible reversal is liquidity offers building up above and kind of a stair step pattern. So you get close to the first level, they start building up there, kind of doing that a little bit at 44.70. Then you should see someone coming in at 75 or 80 and so on and so forth, and sort of stacking those offers above progressively as we move higher. That's something else that kind of tells me it's like a market with the carrot and the stick. They're using the carrot to pull the price a bit because the auction tends to like to go where there's liquidity to release.
Yeah. That 44.70 is a really interesting level. We just saw like on Friday. I'm sure you saw that as well. Like about I don't know, several thousands of icebergs filling, but going, long, or maybe covering, we don't know, but like certainly they were buying. And now we're below that, and now we're seeing liquidity on the offer there.
Exactly.
So then it sounds like, if I can kind of uh, understand your trading methodology, for execution, you're kind of inching in and out, like maybe kind of, or you may do that many times, right? So you'll maybe you're short already a few contracts, you would add a few more in, going with the position, or maybe scaling out a bit on the way down, where that big stop run is, for example, something like this. Are you kind of like positioning yourself kind of an overall for the day type of move, or are you looking for kind of, more of a scalp type of positioning?
So I do trade multiple time frames. Like for example, coming into today, when I saw that this market repeatedly rejected overnight, and then pre-market that same level around 4,500 SPX, where there's a lot of options positioning, that's where I started to build a short, because I felt like my risk reward is pretty clearly defined here. If it moves, 7 points above, I'm going to get out. Otherwise, I'm looking for about 50 points down. So my target is you know pretty well already on screen. I've moved it down a little bit because I see that 44.50 bid. That may prove to be a mistake. It may not. But the conviction of that bidder has me interested in extending my price target just a little bit lower. So that's where I am on the trade for today. Just coming into it with the idea that there's still room for this range to be explored down to about 4,400 SPX over the course of this week. And I think with today's price action and really how those delta and theta decay flows haven't added much of a bid to this market, and the breaking down of the opening range, I'm kind of confident that we'll get to that 44.50, and that's where I'll be flattening out at about 44.51. I don't go right in at their level because it can get a little volatile, or sometimes price can run away, but I usually give myself about a point buffer.
Interesting. So then, I mean, with this kind of trading method, how do you kind of keep track of your different time frames? I mean, you're kind of looking at a lot of stuff, tracking over quite a bit of time too.
So I have, maybe 3, 4 charts that I'm looking at. I'm looking at the weekly time frame, the daily time frame. I'm looking at intraday, and then I'm also looking at, kind of a shorter intraday time frame with Bookmap. And it's actually, I would say, something that makes it simple for me. And the reason for that is, for example, sometimes you see fractals, like you'll see a pattern that repeats on the intraday, the daily, and the weekly. That vastly increases my confidence of an outcome when I see a fractal like that. And so looking at multiple timeframes really helps for that. The other thing is just knowing where those key areas of volume profile are, where people have really liked to transact. And the only way to do that is to really look at it, look at price action over multiple timeframes to discern that. So for me, it behooves me to kind of keep me honest. If I'm not zooming out, then I might develop a bias. But if I zoom out, and I'm going out to the daily and weekly time frame, it's much harder. It's much easier to be more systematic with my approach. So for me, it's just always, ever since I really started to do more swing trading and day trading, it's always been part of my core ethos to look at multiple time frames and ensure that I'm not getting kind of myopic with my view. And I know it doesn't fit everyone's trading style, and some traders, stick to like one chart and they do really well with it. And that's why earlier I said, my trading style might not be for everyone. But I feel like looking at multiple time frames, as strange and maybe as counterintuitive as it may sound, is actually easier for me than to just look at a single time frame, because then it makes it easier for me to do what I'm talking about in this presentation, which is find that coalescence and try to trade off of it.
Yeah, no, that makes really good sense. Okay, so and then for the day trading though, do you typically find yourself scaling in and out?
Yes, I do. Now, out depends a lot on risk management. I might get stopped out. That happens all at once. In terms of taking profit, though, I do like to scale out because look, like when I get into a position, just like when I get out of a position, if I'm going in or out of those positions with the idea that I'm smarter than the market, I'm probably going to get hurt. And I feel like going, just all in once and all out at once is kind of me flaunting price discovery as a process. And I found that over time, backtesting when I use scale in and scale out versus single entry and exit, my scale in and scale out trades are more consistent and they tend to produce better profitability over time. So it's worked for me. And I like the idea of having a core, and once I take that off, when I reach my initial objective, I have runners on and maybe I achieve, an extension to whatever the move is with those runners. But yeah, often is the case that scaling in and scaling out is another part of my trading strategy that keeps me honest.
Yeah, yeah, that makes sense as well. Then are you also trading options quite a bit?
I trade options. I trade multiple time frames of options too. I have been guilty of trading zero DTE. Don't judge me. But I've also traded, options out for weekly, monthly, all the way out to leaps. And I love trading options. I think trading options is a really important way to manage risk. And when done properly, when it's not just a, one-sided trade gamble, when we're looking at diagonal calendar spreads, for example, to express a bullish view, you're affording yourself the opportunity to be a little wrong on timing as long as you're right on the outcome, because you're reducing your total debit by selling that forward, that closer month, and using that to fund your further out position. And there's ways that you can roll those positions where it's not costing you as much premium, and where one part of the trade, theta decay, actually works in your favor. So for me, I like to trade options as a mechanism to hedge, and also as a mechanism for capital accumulation, and also as a way to generate income. I mean, there's absolutely nothing wrong with volatility harvesting strategies on both sides. Like, for me, I might have long positions that are high conviction that I'm not getting out of, and I may decide that there are certain opportunities, particularly when there's a volatility catalyst, to sell call options against elevated premiums so I can gain a little bit of income from the way that that volatility event may make those options relatively expensive in comparison. And if I get called away at a certain strike, that just means I get an opportunity to sell some puts on the other side and eventually get put back into my position. So I do like options a lot for, especially swing trading and investing. I think the zero DTE stuff is very high risk. It's a great adrenaline rush. You can make a lot of money. You can also lose a lot of money. I've had zero DTE trades that were easy 30xers in like a matter of hours, but you have to understand on the other side of it, it can go the exact opposite way. So it's always good to never put a lot of capital at risk in any trade like that, where you might lose your entire principal in a matter of hours.
Yeah, yeah. So, wow. I mean, so you may have then like I don't know, at least five or more trades on at one given time.
I mean, look, I have a swing trade portfolio that I keep in a separate account. Then I have my day trade portfolio that I have in a separate account. Then my taxable that's in a separate account, obviously, than my retirement. So I have in my swing trade portfolio about 20 positions on longs and shorts. Some areas where options are being sold against, either one of that part of the trade. I have my investment portfolio on, where I've got, several dozen positions over the long run. And then I've got my day trade portfolio where, I might get into two or three things during the day, but before the day closes, I'm flat. I don't really carry stuff in my day trade portfolio overnight unless there's some extenuating circumstance.
Yeah, yeah, understood. Okay. Everybody, I had to create a special events, hashtag special events room there. If you have any questions, you'll just see it up above in Discord, or any questions that you may have over in YouTube. Maybe that's the quickest, if anyone wants to ask any questions here, since we have Mayhem and a lot of fascinating things going on here. So get your questions out. Yeah, so let's see. Is there anything else that you want to cover in general, or anything specifically? Like, I mean, I'm fascinated with what you're doing here. Um, yeah, I mean, I just have many questions. I don't even know where to begin with them all. Let's see
Go
if
ahead, Bruce.
yeah, yeah, okay. Well, yeah, Edwin is asking about your tool over in
Yeah.
your options column. When will that be available?
Great question, Edwin. It is something I'm working hard on to make available soon. There's some areas I need to add to because there's a couple of other areas of intraday options dynamics that I'd like to add to it. And then I plan to put it on the Bookmap marketplace. And I really appreciate the support of the whole Bookmap team. Everyone there has been absolutely amazing. For right now, the only place that it is available is on the Traderade Plus Discord. And good news, if folks did want to join us there, and there's no sell here, just if you did, you can get 30% off with the code Bookmap30 until Sunday.
Yeah, I'll put that into the chat as well, so that people can, or if you want to put that into the chat, Trader, it might be better since you
Sure.
have the link. And yeah, so this hashtag special dash events chat room there, and then also over YouTube.
Got it.
Yeah. Any other questions in here? No, doesn't look like it.
The biggest thing that I would say about anything and really just being at this game for a little while is we just have to keep an open mind. That's the biggest key to being successful over time is realizing that you can't always win with the same strategy, that you can't get too confident in yourself as a trader. The moment you think you know everything or that you think you've got the golden touch is the moment you're probably going to blow yourself up. And it's really a lot more about being humble and always being a student of the market and always keeping an open mind. And that's why I continue to plug away at coding and, putting out fascinating charts and sharing ideas and opportunities and just always being a student of the market and the world around me, because I find that finances, there's always something to learn. And you could say that about a lot of subjects, but finance is like a universe within itself. There's so much to learn, and there's a lot of value in accumulating that knowledge because it can make us better traders and better investors, and it can also help us in other areas of life. So the biggest thing that I would leave everyone with today as a thought is never stop learning, ever. The moment you stop learning is the moment that you stop really participating in this wild game called life. And so, as a trader, as a human being, always keep your mind open. Always be ready to learn more because it will serve you well. Having a hungry mind that's well sated with knowledge is your best asset. And that's something that pays dividends more than any investment you can make elsewhere.
Wow, I mean, we should just end it on that. I mean, that is just really nice to hear and very sage advice. I'm wondering, however, if you already have your system, then are you learning other systems, or are you just trying to refine that system? How do you put the learning into optimizing your system?
Sure. So, I mean, I have a number of different systems that I use depending on time frame and asset class, right? And one of the biggest things for me as a trader has been kind of coming to appreciate the varying personalities of different asset classes, because everything truly does have a personality. It has everything to do with who's trading it. So, if I'm trading gold, completely different personality than crude, different personality than 10-year notes, different personality than S&P futures. Euros, I mean, everything has a different personality. So I have different approaches to different markets. What I do to trade the S&P and what we've talked about today is completely different than how I'll trade a lot of commodities or currencies or bonds or even single stocks. Because it's all, you got to kind of scientifically validate that your approach works. It can't just feel right. And you can't just make a couple good trades and be like, yep, I've got it down. I mean, no one who ever was consistently a good trader over a long period of time took such a haphazard approach. So for me, I like to backtest rigorously. I like to identify different ways of managing entry, exit, risk at time exposure. And one thing I didn't talk about today that I can talk about during a future presentation that I think is very important is identifying time as a risk. It's not just our capital, it's a risk, it's our time. What other opportunities could and should we have been in that we weren't because we were married to something that didn't work? So that's another thing and that I test for. There's actually ways to kind of identify key periods of time after a signal is fired off to see whether or not it's really working, right? And again, varies by the personality of the asset you're trading. But that's how I do it, Bruce. I build systems off of a combination of back testing and real person experience, like being in the driver's seat of the system and taking notes as to what's working, what's not working, and trying to continuously refine and iterate and improve.
Okay, so then I mean, I could talk to you for hours, but I'm just curious then. So, like this new options tool, for example. So
Yeah.
it was basically when you presented before, you didn't have this.
No.
So then, and you already had a pretty sound system, but you continued to question, to probe, and to experiment. And you go, well, what if I try it with this? So you had to not only develop this new tool, but then you have to test it. Does it work? Does it have value for you? So I guess this is an ongoing thing for you. You're just always looking at trading this way.
Well, yeah, and so I come from a background of being an entrepreneur and being very sort of autodidactic, applying myself to whatever I'm interested in and taking it apart, putting it back together, trying to make it better along the way, trying to figure out how it all works. And so for me, I began to appreciate just how important options were in driving price discovery in 2021, and then just further and further dove into that, learning more and more. And I've been writing tools to map out options exposure, gamma exposure, volume, gamma flip levels, and so forth, and then modifying tools that have existed to make them better. And so I felt like, because I'm using Bookmap so much and it has some really cool features, I feel like I should just add this in, because otherwise I'm flipping around all these different charts. Like even when I didn't have it in my system, I was always considering it. And even during the last presentation, options were like one of the drivers of the theme of convergence and coalescence. So I felt like, I could probably save myself a lot of time just putting this right on the same screen. And I'll be honest, look, like any other human being, I default to trying to be lazy where it's smart to be lazy. And one of the areas it's smart to be lazy is not looking at 6 million screens to find your data, right? So if I was already looking at this data, I figured I may as well just add this right into Bookmap. And then that way I can make more informed decisions with less mental fatigue.
Yeah, absolutely. In fact, it begs the question for creating a heat map based off of your options levels there within Bookmap.
Yes, that would be awesome. And if you all ever want to collaborate on any such projects like that, I would be 100% interested.
Okay, yeah, I'll put the word out. I mean, we've been playing around with things in options for a while, and I don't think we never really came to something, but this kind of codifies it, or at least focuses it on some of those thoughts. It makes good sense. It's just coming to light now.
And it's really, when you look at all of the trading that happens every day, 70% of the notional value that exchanges hands is expressed in options, and over half of that within 6.5 hours or less to expiration. So it's such an important driver of price discovery and just about everything. Like anything that has a liquid options contract, it often ends up being the tail that wags the dog. And we can look at it in single stocks. I mean, look at for how long Tesla's options were the most active by multiple fold of any stock, including those that were, Apple, or 3 times its size. And that was a big determinant of price discovery in the underlying. All of that near to the money, close dated call options buying really helped to squeeze price higher by multiples over a period longer than a year. And we've seen this in other cases. SoftBank at one point was actually pushing up their portfolio by doing a lot of unsavory options buying, and they got caught. I think it was in 2018 or so, but it still demonstrates the value of understanding these flows and watching them.
Yeah, makes good sense. So I don't see any other questions, Mayhem. I'll give you the last word, but love to have you back. Absolutely, really, really fascinating stuff. Yeah, if you can leave us with any parting advice.
Yeah, sure. First, Bruce, always appreciate the invite. Really love the Bookmap community, the software, everyone on the Bookmap team. You guys are all awesome. So it's a pleasure to be here, and I look forward to the next opportunity to join you all. And in terms of parting words, I would just say, look, I know that, going into this year, a lot of folks, including myself, thought we'd probably see a different type of market. We've not seen that type of market yet, but I don't know that all of that has been necessarily canceled. I think it's been forestalled. So, in my humble view, just from a longer term perspective, I do think we're at a risky inflection point in the market. It's something that I've been talking about quite a bit at Traderade and Macrovisor, just due to positioning dynamics. You have sentiment, flow, positioning, all at stretch levels that are what we saw in November 2021 or worse. And that's just telling you there's a lot of euphoria out there, particularly concentrated in certain outperforming parts of the market that have risen more because of multiple expansion than fundamental improvement. And I think that elevates risk. So if folks out there have had a really good, year and they've got a bunch of longs in these areas that have run significantly, probably not a terrible idea to consider whether it makes sense to take profits or hedge. Hedges are historically cheap here. Just some thoughts. I don't know that the back half of this year is necessarily going to look like the front half, and I think the next couple of months could be a little tricky out there. So, also be sure that if you've been trading this market, it's been kind of set to easy mode, that you identify that there is a change in character that's happened over the last several weeks. It's changing intraday trading dynamics too. Speaking of options, for the longest time this year, at the money put premium was being sold to fund buying out of the money, close to the money, call premium, 0 DTE, right? Now we're seeing those dynamics shift a little bit on down days. We are seeing at the money call premium being sold to buy out of the money puts, and that does add to some of that downside pressure. So why is that important to me? Because it tells me that there is a character change happening in this market. We are going to be entering a more vulnerable period from really Thursday of this week on for the next 2.5 weeks after that. There's some structural weakness in the way that market flows happen that could predispose us to wider price ranges, right? And just finally, if you look at my Bookmap stream, if you're still on it, you can see the hot put move down significantly here. Now below the guy who's sitting at 806 at 44.50 on that resting bid. That's telling me that, we are actually moving into a dynamic where possibly we do see some lower push to price discovery. So all of that, I really just like to look at the market through multiple lenses: macro, fundamental, technical, flows, sentiment, positioning. All of it adds up to pictures that help me quantify my risk and return potential, and also whether or not I even want to be in a trade. The last thought I'll leave everyone with is sometimes the best trade that you make is the trade that you did not take. There's no reason to always be in. Look for your opportunities and choose them wisely.
All right, excellent. Well, thank you so much, Mayhem. And we look forward to doing another one again with you soon.
Sounds good, my friend. Well, thanks again for having me. I hope everyone out there has a great rest of your trading week. I will see you around.
Bye-bye.